This video is about stock losses. Look at this stock card. At the end of March, the 31st of March, it shows a balance of 20 units on hand, $1,000 a unit, $20,000. From time to time, the business will check the accuracy of its stock cards by doing a physical stock take. A physical stock take is when they go into the storeroom or the warehouse and they physically count the stock and they compare the results of the physical stock take with the stock card to see what is the situation. Has there been any stock lost? Has there been any stock gained? It is assumed that the physical stock take is accurate. It's more accurate than the stock card. So in this situation here, they've done a physical stock take and it's recorded on this little memo here, memo number 77, and it says there's 19 units on hand. So somebody has physically checked the storeroom and found 19 units on hand. That obviously is different than the 20 units the stock card says. There's a discrepancy of 1 unit. There's less stock than the stock card says there should be on hand. That is a stock loss. We've lost 1 unit. It might have been stolen by staff, by customers. It could have been due to an under-delivery by a supplier which wasn't detected at the time. It could have been due to an over-delivery to one of your customers which you didn't appreciate at the time. So there's a variety of different reasons for the stock loss, but we have to record and then report the impact of the stock loss. So the first thing to do is to record it into the stock card, memo 77 in the details column. And in the out section, 1 at 1,000, which reduces the balance to 19, which is exactly the same value as the physical stock take. The stock card must finish with the same value as the physical stock take because it's assumed that's the most accurate figure. But there's more. We have to also record the stock loss in the general journal. So here's the date and some sort of narration which explains what's happened. Stock loss of 1 unit, memo 77, and the value, which in this case is $1,000. So the stock loss is recorded in really 3 places. Once on the document, the memo, once in the stock card in the out column, and thirdly in the general journal, $1,000. How do we report the stock loss? Have a look at the cash flow statement. Stock loss does not appear in the cash flow statement. Stock loss is a non-cash transaction. It does not appear in the cash flow statement. However, it is an expense, so it does appear in the income statement. And it's going to appear underneath gross profit. So when you get to gross profit, you go less stock loss, in this case $1,000, and that $1,000 then reduces the gross profit to what's called adjusted gross profit, in this case $26,300. So stock loss is reported in the income statement. It reduces gross profit. It creates a new little subheading called adjusted gross profit, and then the income statement continues on as per normal. And of course, in the balance sheet, that stock figure of $19,000, that is the figure as per the physical stock take. That's the most accurate figure. You verify that by doing the physical stock take.